With this new strain of the virus, there's a number of uncertainties. One is, does the vaccination actually stop it? Is it more infectious? And finally, what are the symptoms, right? So quite a lot of unknowns. And given the fact that we don't know the answers to this, then short-term positioning, and be mindful we're now at the beginning of December, between now and the end of the year, I think many investors in this region might want to be positioned in those companies which offer a lot of safety. And in Asia, there's so many of these companies. We've got incredibly strong balance sheets. So if you take where balance sheets are relative to a year ago, then company cash balances are up 17%. Chetan Seth, who's our strategist in Singapore, he's done a bit of work on this. And the strength of the balance sheets really show that companies here have been quite resistant to COVID. And therefore, there's plenty of choice for investors that want to be in a safe haven until we know more information about the new strain of the vaccine.
It's the uncertainty that's killing us, isn't it? And it also kills the markets until we have further clarity. The thing is, in the past, whenever there's been bouts of volatility, buying the dips has been a very successful strategy, not least because of the central bank put. Is the idea of the central bank put, however, getting tired?
Well, I guess what we've got now, the Fed is now in a really difficult position, because ultimately we know that inflation is really running through the US and also in Europe. Asia appears to be more insulated. So the Fed's got to work out, does this new strain of the virus really compromise growth? Or should the Fed really start increasing rates to counter inflation? And that's a real dilemma. So yes, in the past you buy the dips. I think in Asia, that probably has got some more substance to it, because Asian markets are quite depressed in terms of valuations. Now, in particular in Japan, and I had a call with Ikeda-san, who's our Japan-based equity strategist, and he sees three things happening in Japan. You've got share buybacks at the highest level for 10 years. You've also got capex levels at the highest level that have ever been. And then finally, you've got dividend growth, which again is an inflation hedge. So I think short term, we are a little bit jittery. But going into 2022, markets are not expensive in Asia. And be mindful that MSCI World, 70% of that index is the US. So stock market valuations are elevated simply because of the US. In Asia, they're actually quite sanguine.
Jim, can we handle taper and tightening when it does come from the Fed, or is it going to be messy?
I think US markets are going to be much more volatile as the Fed decides to tighten a little bit, because here in Asia, companies' capital structure is very, very different. So again, looking at China, more than half of the top 100 companies are sitting on cash. In Japan, it's more than half. Korea, Taiwan, again, big components of the indices, then companies are sitting on cash. In the US, companies have a capital structure which is much more efficient, so they have borrowing in order to give better returns for shareholders. So that means that the cost of borrowing actually goes up. Whereas here in Asia, companies are quite conservative, and that relates to legacy, Confucian values, the Asian financial crisis, and that means that companies are better positioned to withstand more expensive money.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.